Have you ever actually looked at a dollar bill or the digital numbers sitting in your banking app and wondered how on earth they magically transform into towering skyscrapers, cutting-edge medical breakthroughs, or even the device you're literally watching this on right now? Because honestly, it feels like a total mystery.
Welcome to Rich Tribe.
It absolutely is a mystery, right up until you understand the hidden machinery working behind the scenes. I'm your guide, and today we are unpacking the ultimate black box, the global financial system. Stick with us until the very end of this explainer because we are going to show you exactly how the money in your pocket literally moves the entire world. Okay, guide, let's jump right into this. How does my incredibly boring everyday savings account actually fund massive corporate innovation? Like, how does my money help Apple invent a better iPhone?
That is a phenomenal question. So, at its absolute core, the financial system really only exists to solve one massive structural mismatch. On one side of the equation, we've got what we call lender-savers. That's households and individuals, people like you and me, who have surplus funds relative to what we actually need to spend today. And then on the flip side, we have borrower-spenders. These are the businesses and governments out there with amazing ideas and big investments to make, but they have a severe shortage of the capital required to actually execute them.
To connect those two sides, the whole network functions exactly like the economy's plumbing system. Seriously. Think of the central bank as the main city water pump. The liquidity reserves are like a giant pressurized water tower, and commercial banks act as the distribution pipes that allocate credit through different faucets straight to where it's needed most. You can also think of it like a domestic heating system that's working constantly to keep the economy's temperature perfectly balanced. Okay, I love the plumbing analogy, but what happens if the pipes burst? Or what if the pressure gets totally unbalanced? Well, if the valves fail, the liquidity just stops flowing. Period. You end up with severe credit squeezes in one room of the house and crazy speculative bubbles blowing up in another. It's basically an economic heart attack. So, to keep those pipes from bursting, this plumbing is built using two primary structures. Let's move into Section 1, direct versus indirect finance. We essentially have direct finance and indirect finance. In direct finance, the borrowers sell securities, things like stocks or bonds, straight over to the lenders. Super simple. But in indirect finance, a middleman steps into the picture. A bank takes your deposits, pays you a little bit of interest, and then turns around and loans that money out to someone else at a higher rate.
Wait, hold on. Let me clarify something really quick. Let's say I'm a household and I decide to buy a newly issued government bond, but I do it using a broker. Does that count as direct or indirect finance? Because there is literally a broker sitting right in the middle.
That is a classic trap. It is still direct finance, and here's why. Because no asset transformation actually took place. That bond is sold by your broker in its exact original state. At the end of the day, you hold a direct claim against the government, not against the broker who facilitated the trade.
Now, to really see the difference, look at how intermediaries like banks manage risk when they actually do step in to create indirect finance. Let's examine the balance sheet.
It just says assets.
Exactly. Because when a bank uses indirect finance, they take your short-term deposits and they transform them into entirely different long-term assets, like a 30-year mortgage. The bank, not you, is fully bearing the risk of that transformation.
Challenger. Wait a second. I see plus capital loan happening right next to plus deposit. Are you telling me banks just create money out of thin air when they make a loan?
You absolutely nailed it. It's basically a form of modern monetary alchemy. Just like the famous economist Joseph Schumpeter pointed out, banks can literally create a deposit at the exact same moment they create a loan. They're giving immediate purchasing power to entrepreneurs who don't have it, and they do this without requiring any individual saver to cough up their funds first.
Wow, that sounds exactly like a free lunch.
It kind of does. But the absolutely crucial point here is that this newly created money mobilizes unused economic resources. If that entrepreneur uses the new money to buy goods or hire labor that would have otherwise just sat entirely idle, it actually increases real economic activity instead of just driving up inflation and prices.
Challenger. Let's bring this down to earth for a second. Say I'm going out to buy a car at my local Ford dealership. How do these abstract finance methods actually impact me, the regular consumer?
That is the perfect real-world example. If you go directly to your personal bank, get approved for a car loan, and then physically walk into the dealership with that money ready to go, you're using direct finance. You control the whole process. But if you just sit at the dealer's desk and let them send your application out to their massive network of third-party lenders to find you a package, Well, that's indirect finance.
Ah, okay. So direct means I have way more control, but maybe have to do a bit more legwork, while indirect is super convenient, but I'm completely relying on the dealership's network.
Challenger. So where do all these abstract transactions actually happen in the real world? Are there just giant marketplaces for all this stuff? Guide. There absolutely are. Let's break down the actual marketplace itself in Section 2, Markets, Money and Capital.
The whole system is broadly split into money markets and capital markets, and this split is based entirely on maturity, basically how long until the debt is actually due. Money markets are strictly for short-term instruments that mature in under 1 year. They're used for super quick, everyday liquidity. Okay, that tracks. So money markets handle short-term stuff, like T-bills and CDs, and capital markets handle the big things over a year. Mortgages definitely make sense there. But wait, corporate stocks? Stocks don't even have a maturity date. Why on earth are they in the capital markets column? Spot-on observation. Corporate stocks are conventionally considered long-term capital market securities precisely because they have no maturity date. They represent permanent, ongoing, long-term funding for a corporation. All right, so we've got this massive plumbing system full of short-term cash, long-term mortgages, and banks doing financial alchemy. Who is keeping this whole crazy thing from exploding?
That huge responsibility brings us to the central bank. Let's take a look at Section 3, the Fed's control valves.
The Federal Reserve acts as the ultimate pressure valve for the entire United States economy. They actively manage the money supply using primary tools like interest on reserve balances, the overnight reverse repo facility, the discount window, and open market operations. By constantly tweaking these specific administered rates, they effectively steer the federal funds rate, which basically serves as the foundational baseline interest rate for the entire economy.
Challenger, I definitely need some specifics here. How does setting this so-called reservation rate mechanically prevent the federal funds rate from falling below whatever target the Fed sets? Okay, think of it exactly like a floor. The Fed literally pays commercial banks interest on the cash reserves those banks keep stored at the Fed. Because this is a guaranteed 100% risk-free return, no bank in their right mind would ever lend their money out to another bank for less than what the Fed is already paying them just to sit on it. It creates an incredibly solid floor right under market interest rates.
And to make sure those interest rates actually work as intended, the Fed constantly needs to maintain ample reserves in the system. They do this using open market operations. Walk me through that. How do these open market operations actually work, step by step? Sure thing. Step 1. The Fed goes out and buys a government security, like a standard treasury bond, directly from a bank. Step 2. The Fed pays for that bond simply by crediting the selling bank's reserve account at the Fed. Step 3. Boom. The overall level of reserves in the banking system just expanded. They literally inject fresh money right into the plumbing to keep the system's pressure high enough for their interest rates to remain completely effective.
We are going to look at the mind-blowing future of this system in just a second. But first, if you are finding this breakdown helpful, please subscribe to Rick Tribe channel, like, comment, and share. It really helps us keep creating these explainers for you.
All right, guide, we've talked plumbing, central banks, asset transformations, and even car loans. But let's zoom all the way out for a minute. Why does understanding this complex architectural breakdown actually matter to our daily lives?
It matters deeply because without this specific system in place, global economic growth just stops entirely. Let's synthesize what this architecture actually achieves in Section 4, why this matters today.
The World Bank actually identifies these 5 core functions of the financial system. When financial intermediaries successfully pool our collective savings and allocate that capital efficiently, they are actively directing funds to their most productive possible uses in society. This is literally what supports business expansion. It's what funds life-changing technological advancements. A well-functioning financial system drastically eases the friction of transaction costs so that goods and services can actually be exchanged smoothly in the real world.
Challenger. But wait, technology is moving incredibly fast right now. What about things like CBDCs, central bank digital currencies? If a central bank can just issue digital currency directly to my phone, couldn't that completely bypass traditional commercial banks entirely?
Guide.
You just hit on the massive disruption currently looming over the entire global system. CBDCs absolutely have the potential to completely rewrite all the plumbing we just talked about today. They could massively enhance payment resilience and boost financial inclusion, but they fundamentally challenge the traditional, historical role of commercial banks acting as the primary middlemen, which naturally leads us to a fascinating, somewhat terrifying crossroads.
Exactly. If digital currencies make direct finance the new normal for everybody, do we even still need all that old plumbing?
And that is the ultimate question we have to figure out. Remember, risk is never truly eliminated in finance, it just moves somewhere else. If we completely bypass banks, who is going to monitor the investments? Who manages the massive solvency risks? The entire financial system is evolving right before our eyes, and honestly, understanding its foundational plumbing is the only way we can navigate what comes next. Thanks for joining us on Rich Tribe. Keep challenging the system, and we will see you in the next explainer.